Welcome back, Focus Learners. Today, we're diving into a brand new explainer where we're going to connect some seemingly random dots to figure out exactly what is happening in the global economy right now. We'll trace the incredible surge in physical copper demand driven by AI, follow that thread straight into the macroeconomic shifts hitting the US, and finally, look at how massive currency shocks overseas should absolutely be reshaping your portfolio. We've got a lot of ground to cover, so let's jump right in.
All right, let's kick things off with a number that is, well, it's just absolutely staggering. 60%. That is exactly how much the price of copper has skyrocketed since April 2025. It's this massive, accelerated climb, and traders are currently eyeing a major target of $15,000 per metric ton as we push through 2026. And you have to understand, this isn't your standard commodity cycle. No, this is a fundamental repricing driven by a totally new, incredibly thirsty consumer entering the global market.
So to make sense of all this 2026 volatility, we've split our agenda today into four key areas. First, the AI copper boom. Second, a K-shaped economy. Third, currency swings and shocks. And finally, the alternative defense.
Let's start right off with Section 1, the AI copper boom, or really what we should call the physical cost of AI.
To really put this physical cost into perspective, think about this. Building just one 1 gigawatt AI factory requires a massive 50,000 metric tons of copper. It's wild. AI training and inference demand just an unbelievable amount of computing power and electricity. So that means vast new requirements for cooling systems, internal cabling, switchgears, and of course, massive power grid upgrades outside the data center just to get the juice to the front door. And because of this, S&P Global is projecting that data center copper usage alone is going to more than double. We're talking about growing from 1.1 million metric tons in 2025 all the way to 2.5 million metric tons by 2040. Because these massive investments in grid connections and transformers literally have to keep pace with AI expansion, it creates this highly inelastic demand for copper, meaning tech companies have to buy it virtually no matter the cost, which is exactly what's pushing us toward that $15,000 threshold.
Transitioning now from the red-hot demand of data centers to the broader economy, let's look at Section 2, a K-shaped economy and the macro reality check.
So looking at this analysis from JP Morgan Asset Management, we have this fascinating situation where AI investment is almost single-handedly propping up U.S. economic and earnings growth. It's doing all the heavy lifting. But beneath that high-tech lift, there's a severe economic drift kind of pulling us down. We're talking about tariffs, mounting debt, sticky inflation, and just generally soggy overall growth. So the AI roof looks great, but the broader foundation, it's under immense pressure. And right beneath that resilient tech-driven surface, we are experiencing what economists call a classic K-shaped expansion. On the upward arm of the K, you've got a booming stock market enriching top earners, generating substantial wealth that's supporting spending on high-end services. But look at the downward arm. Higher tariffs are acting as a major drag on real consumer spending, and lower immigration is tightening the labor supply. This creates a severe squeeze on middle-class consumers, which leaves rate-sensitive sectors of the economy, like housing for instance, looking decidedly soggy.
Now, this severe economic divergence has created a deeply divided Federal Reserve. On one hand, you have hawkish committee members grappling with inflation that's hovering around 3%, which is definitely being exacerbated by those tariff impacts. But on the other hand, the dovish members are pointing to slowing, sluggish job growth. Because the Fed is constantly weighing risks on both sides of its dual mandate, JP Morgan analysts expect they're going to tread very, very carefully. We're likely looking at only 2 to 3 shallow rate cuts through all of 2026.
So, how does this economic divergence create global shockwaves? Let's shift our focus overseas with Section 3, currency swings and shocks. A perfect example of this exact volatility hit earlier this year. Back in January 2026, we saw an extreme unwinding of carry trades, where investors borrow low-interest currencies to buy higher-yielding ones. As shifting yield differentials sparked panic across the board, it culminated in a historic move. The U.S. Treasury actually engaged in a joint intervention to stabilize the Japanese yen. Guys, this was the first intervention of its kind since 1998. It just proves how fragile the global currency balance really is right now. To try and better forecast these chaotic, market-shaking currency movements, researchers over at the Bank of Japan are turning to highly granular transaction-level data. They're actually utilizing trade repository data on foreign exchange options to capture heterogeneous views. Basically, they're mapping out how individual market participants differ in their perception of risk. By looking at the implied volatility, or IV, that's priced into these option trades, authorities get this incredible real-time window into investors' expectations of future turbulence. And the BOJ research is fascinating. It shows that by combining macro financial variables like the VIX index for broad market sentiment and the two-year yield differentials between the US and Japan with the unique hedging activities of these investors in the FX options market, they can actually predict large currency swings. Basically, when certain investor groups who have informational advantages start hedging heavily, their heightened risk perceptions act as a really powerful early warning indicator for massive unexpected currency swings.
All right, bring this all together with a K-shaped domestic economy, an AI commodity squeeze, and overseas currency shocks. We arrive at Section 4, the alternative defense, or getting your portfolio on side.
The reality is, a traditional 60-40 stock and bond split simply might not cut it anymore. And this is exactly why alternatives like venture capital are so vital right now. They offer a critical way to truly diversify into the AI theme. Everything from specialized semiconductors to large language models. The massive spending by hyperscalers is actively transferring value from public to private markets. Plus, remember the DeepSeek disruption earlier this year? Yeah, that proved just how unpredictable and vulnerable concentrated public tech markets can be. It really makes private equity and venture capital essential for balanced AI exposure.
Ultimately, your 2026 defense playbook needs to be extremely diverse. Beyond private equity, you should really be looking at international equities. They are actually closing the earnings gap with the US right now, thanks to higher nominal growth and new, really shareholder-friendly policies like stock buybacks in places like Japan and Europe. You also want to consider diversifying with hard alternative assets to hedge against all this inflation and the currency shocks we just talked about. It absolutely includes physical gold, safely stored in highly secure non-bank vaults in jurisdictions like Switzerland or Singapore, a strategy that's heavily highlighted by specialized firms like Von Greuers.
So as we wrap up this explainer, I want to leave you with one final, pretty important thought. With AI rapidly draining physical resources, a fractured U.S. economy showing a clear K-shaped divide, and historic interventions rocking global currencies, is your portfolio truly on side, properly diversified, and actively prepared for the 2026 macro drift?